Hello, my name is Sasha Star. We start our Wednesday's investment show. It's Modern Investment with Sasha. And I have a very special guest today. His name is Shakeel Latimer, and he is a great investor, professional. And so we're in for the great show. Please enjoy. Hello, Shakeel. How are you doing today?
I'm very good. Thank you, Sasha. Yourself?
I'm doing fine. It's very interesting. We have, of course, we've had many discussions. We have somewhat different approach, and neither one is right or wrong, because your approach is always as a professional investor foremost and a fund manager, and my approach is basically as individual investor. And so our approach to the market, technique, positions, what we're using, somewhat different. It doesn't mean that I'm right and you're wrong, or you're right and I'm wrong. It doesn't really work that way. Just different perspectives, different approaches, different goals. However, what I said earlier today.
Oh, sorry, Sasha, I just missed the last thing you said.
Sorry?
I just missed the last part of your question. I'm sorry.
Oh, no, I haven't asked you anything yet. I'm just trying to repeat what I said earlier today. That it could be a scenario. I'm afraid of that scenario, but it could be that the next 5 years, or maybe even earlier, a lot of people, if not most people, will not have a regular 9-to-5 jobs, or something that would bring them a steady income, and they would not be able to rely on government checks or subsidies or whatever. And they must, even if they probably don't want it, they must learn about investing and trading to be able to generate, regardless of the market, regardless of what's happening, at least $300-400 a day, in order to sustain themselves and their families. So it's not going to be like today. Investing for most of the people means something to find better opportunities than to get 1% on fixed income. So they need to support their pensions, maybe, or lifestyle, certain what they like. So they're looking at some investments or so on. Some of them do, some of them don't. But it could be a situation in the near future that they will simply must learn, because that's the only one area where I can see people can really sustain themselves. Of course, if they're doing it smart, the right way, and hopefully we will be able to help them to do exactly that, right, Shakeel?
Absolutely. I think that investing in the stock market, it can seem like quite a scary place, and for people that are just starting out, especially if you're going to talk to somebody like myself who has so much more advanced knowledge about the markets, you might feel, oh my God, I don't know as much as some of these other professionals, and what am I up against? But, I say to people, it's okay for you just to focus on the things that you already know, the things that you're already good at. So for myself, for example, I tend to stay away from tech companies, not because there's anything inherently wrong with tech companies. It's just that I don't understand their business models and their revenues as much. So being 36 years old, I really should know tech a lot better than I do. But it's just not, it's just not where I tend to focus a lot of my energy. I do focus and trade heavily the bank stocks because I tend to know them a little bit better and how they operate. But that's what I would say to people is, focus on the things that you know, and that's a good place to start, and then you can broaden your horizons. And there's definitely, an income to be made if you do it safely and you manage your risks and things like that. But the main group of people that I think are really, over the next 5 and possibly even 10 years, that are really going to suffer are those people who, the baby boomers who are coming up to retirement or have just retired, and also the people who are a little bit older, who are sort of in their 80s and they're sort of in that age range, because what they've had to go through is they've gone through the tragedy of 2001, where we had the September 11 and then the war that happened after that. So they saw a massive decrease in their pension fund money, or their superannuation fund, as we call it here in Australia. They saw a massive decrease in that, and then that recovered. But they sort of called that the sort of flat decade, didn't they? Because between 2000 and 2010, you kind of ended up flat. And of course, just before 2010, you had the 2007-8 subprime crisis, and that had a devastating effect on the market, and again had a devastating effect on people's portfolios. And now you come into 2020, some 12 years later, and the US economy is just starting to sort of recover under the last few years of the Obama administration, and then under Trump, obviously the market has gone up quite substantially, and people were doing really well. And then again, you've seen this massive decrease, and this is a different animal altogether. What we're dealing with today, it's not September 11, where it was a one-off thing, and then a war happened afterwards, or the subprime crisis, which affected many parts of the world, but there were some parts of the world that sort of benefited from it because of relative difference. So, for example, Australia, we actually did quite well in Australia over that period of time. But the coronavirus, it affects pretty much everybody pretty much equally. Some countries and some states obviously have a higher fatality rate than others, but it is something that is widespread across the world. And so it's going to be very interesting to see how people, not just in the United States, but how people across the world are able to actually deal with this and move forward.
Okay, so basically what you're saying is that let's call it market calamities, because you can't. Okay, then you go into subject. What was a depression? What was a recession? What was a some kind of a drop of the market of all of a sudden, or so? It's a part of life, part of investments, and it's like cycles. It's like remember I asked one. I think I asked Cam Johnson on the show. I asked him, what's the difference between depression and recession? And he didn't know. But he asked me, so what is it? I told him, well, recession is when your neighbor is out of job. And depression is when you are out of job. But you see, there are certain cycles. Some of them are quite predictable. For example, almost every fall, market drops almost every fall. Actually, I'm trying very hard to remember which fall market didn't drop, and I have difficult time to remember. However, the first rule of investment: never try to time the market. You will always lose. It's impossible to do. But if every fall, the last 500 years, market drops, well, so 501st year, all of a sudden markets will go higher in the fall. I have difficult time to comprehend it. What about you, Shakeel?
There's an old saying that actually one of the people that originally sort of taught me, who actually originally taught me sort of about finance when I was very, very early in my career. There's an old saying that sort of all the brokers used to say, and they'd say, sell in May, stay away, because the market kind of tended to trend down. And look, you do see correlations, and you do see cyclical events. You especially see this in the commodity markets. So things like wheat and meat stocks and things like that. You will often see sort of cyclical movements that are reasonably predictable, and that doesn't necessarily mean that you're going to win that trade every single year, but you might win that trade most of the time. and that becomes a question: are your gains bigger than your losses are? That's something that I think is of course very important to have a look at. But the other thing that I talk about, and I may not have said this quite as clearly because we had such a big panel obviously on our Monday sessions, but relative difference is something that's really important to look at. When you look at the hedge funds and pension funds, I can't attest for what they all do, but one of the types of strategies that they tend to use is what they call market neutral strategies. And so a market neutral strategy is a strategy that is designed not to make or lose money based on a big event moving the market, but it's based to make money in all sorts of market conditions. And so some of the examples of that is you might compare, for example, the Dow Jones to the S&P 500, or you might compare the NASDAQ to the Russell 2000, or the Russell 1000 to the Russell 2000, or something like that. And you might look at that and say, okay, well, the Dow Jones has moved up by 10%. The S&P 500 has only moved up 2%. Does that seem a little bit high? Should I perhaps take a short position on the Dow and a long position on the S&P 500, hoping that the 8% differential will actually come back together and close? Now, in that type of trading scenario, it wouldn't matter if we experience something like what we just have, what we call a black swan event, where the whole market drops significantly. Because if the whole market dropped 30%, the S&P 500 drops 30%, and the Dow Jones drops 30%, well, you're still square on the position, and you're actually only playing the relative difference. And of course, when you look at that from an international perspective and a macro perspective, you can actually look at various markets and say, well, do I believe that the United Kingdom might recover from this faster than the US is going to? And with the backdrop of Brexit, it's going to be very interesting to see how the UK's economy is going to perform, whether that will skyrocket or whether that will, do quite poorly. That was already a big question that I've been asking, a lot of the people who work with me, what do we think is going to be the likely result of the UK economy? That with the backdrop of COVID, you can then compare those sorts of countries and those sorts of economies. Another interesting correlation is Australia and Canada. So Australia and Canada, the dollar is it sits normally pretty close to parity. At the moment, the Australian dollar has dropped down. I haven't looked at it for a little while, but last time I checked, it was around the 90-cent mark, which is quite low for the Australian dollar against the Canadian. But a few years ago, it was up at the $1.10 mark. So again, there's trading possibilities there because the countries, as far as economies are concerned, are very similar. They're agricultural exporting countries and they're mineral exporting countries. So those economies are very, very similar, and you can try and make judgment calls about whether one economy is doing really well comparative to the other. Is it worth taking a position on one and taking a short position on the other and thinking that one economy will outperform the other one? To me, that's an easier way of trading. Once you're advanced enough to do that, that's an easier way of trading than looking through the thousands and thousands of stocks around the world and trying to hone in on one stock and do a whole heap of fundamental analysis and go, this is the stock that I want to buy, and this is something that I think is going to go through the roof.
Excellent. I agree with everything what you just said. I'm not so sure whether individual traders, especially those who just started or about to start, if they are equipped, maybe I underestimate them, but if they're equipped to take this market neutral position or take on a spread between, for example, Australian dollar and Canadian dollar, you're absolutely right in your observation. I think every trader sooner or later will find his individual style, will find his preferences. He will master one where he has to. He is better master one way or another, whatever is suitable for him to trade. I'm not doing the futures and commodities stuff because what. Sometimes you get trading stocks and options, and it works for you. And sometimes you just get either lazy or ignorant, or I will not know how to call it, because I always try to learn something new and try something new. But for some reason, okay, So, okay, that works for me. I know, for example, a few traits I can describe actually. It's interesting to take an outlook and to have your opinion on some of the traits. And all of a sudden, you're going into not so well known territory where you are. You have to take a position. For example, that spread, I like your idea about Canadian Australian dollar. I think there are opportunities for sure. Um, I think, of course, maybe even gold silver spread could look quite interesting because I noticed that gold is on a way up these days, but silver is doing even better. So maybe you can take a spread there as well. What do you think about
But
that?
that was actually something that I had suggested. So I've got a business partner of mine who runs an education course in Australia, and it's obviously very focused on Australian investors. And we have a particular gentleman in that course who is originally from South Africa and really understands the gold markets very, very well, and his predictions are normally pretty good. And I actually brought that up with him, that gold seemed to have gone up. This was several months ago, that gold seemed to have gone up very, very high, very, very quickly. And then what we didn't see at the time was a similar kind of move in silver. So I said to him that I thought silver relative to gold might actually make a move, and it did actually make that move that I was expecting. But the other thing that I might just say, I'll just address two things that you said there. When people are first starting out, I think it is really important that they just stick to the basics first, worry about the other stuff later. So, for example, when I'm talking to Australians and New Zealanders as well, New Zealand does have a stock exchange. There isn't very many options over very many of their stocks, and there's not a great deal of liquidity. But because New Zealand and Australia are so close, we're sister countries. New Zealanders tend to trade the Australian market, and they have access to the Australian market on very similar sort of terms as what Australians have. Probably, I assume, it'd be very similar with Canadians and the United States. But what I would say to Australians is that, there's not a lot of people who are actually going to be able to work the market during the time that the markets are open from 10 a.m. to 4 p.m. because most people have got a job. And so what I would say to people is that, slow down your trading firstly. You don't need to be day trading or trying to day trade, all day, every day, because it's not necessary and you're not going to have the time. But secondly, stick to the companies that you know. So if you're in Australia, every time you turn on the news at 5:30, 6 o'clock at night, you're going to hear about a handful of companies. You're going to hear about the big four banks that we have in this country. You're going to hear about the big telecommunications company that we have in this country, the major airline that we have in this country, a couple of the major shopping centres. Those are companies that you're going to hear every day, and you know them. They're companies that you see every day. You drive down the street, you see their buildings, that sort of thing. So that's what I would say to people is, just start with the stuff that you know. If you're in the United States, start with, and this isn't a recommendation specifically, but, start with a company that you know. If you shop at Walmart, you've got a pretty good feeling for Walmart, have a look at Walmart stock. It doesn't necessarily mean you're going to buy Walmart or sell Walmart, but you just get a feel for Walmart. Or if you're, if you're very interested in tech, maybe you're looking at Microsoft, or you're looking at Apple or Google, or any of those sorts of companies, Alphabet, I should call them. Any of those sorts of companies that you're used to and that you know. Stick with those first. There are, of course, a whole heap of other opportunities. And one of the things for me personally that I'm not very good at is picking those companies that are relatively small cap. There are people that make a tremendous amount of money and make a really good living out of studying junior mining companies and resource companies, and this is a big thing in Western Australia, which is actually where I'm originally from. We have a big mining sector, and there's people that really specialise in finding those undervalued assets.
It's big in Canada too.
Big in Canada as well, absolutely, and big in South Africa, where you can actually find these companies and go, hey, this is a great company. The share price is only 30 cents. It has a market cap of $200 million, and you buy some shares in it. And the next thing you know, they were actually looking for gold, but they found oil, or they found gas, or they found something, and all of a sudden the share price goes from 30 cents to $10, and you've made an enormous amount of money.
Also, they can become takeover candidates quite easily.
Absolutely. Absolutely. So that's great, and for those people that are able to do that, hey, that's fantastic, and you can make some really great returns. But for me personally, I'm not very good at that. So I stay away from that, and I focus on the things that I'm good at. But the other thing that I'll just say to anybody starting out is, it's like with economics theory. For those viewers who watch us on Mondays, who may not have quite picked up on some of the things that I say to people like David K. Johnson and some of the other people who are more economics minded. I tend to believe a little bit more in monetarist theory than I do in fiscal theory. But that's, to me, there is no right or wrong answer there. I mean, that's the great thing about economics. You can never be wrong. You can never prove that you're right, but you can never be wrong either. So it's perfect, right? It's a very sort of, artistic way of doing things. It's just say what you like, sort of thing. But there are some very interesting theories there. What we actually saw, and I'm not sure how big on the news this was over there, but what we actually saw earlier this year was a breakdown that occurred that I believe is the first time that we've actually seen this in history. So generally speaking, people consider gold to be a safe haven. So when the US dollar is falling, when there is a calamitous event, people tend to rush to gold, and gold prices go up quite significantly. What you will also tend to find is that things like 10-year notes will go up quite high as well, and you will tend to find that their yields will drop. That's how bonds work. When their price goes up, the yield drops. And what that will happen when the market itself is falling. And there were actually a few weeks there where gold, the 10-year notes, and the markets all fell at the same time and all rose at the same time, which actually put all of those correlations totally out of kilter. And a lot of professional investors were left scratching their heads going, well, what do we do now? The other very interesting thing that I might just point out, and this might be a little bit more advanced than what your viewers are used to, but you may have heard in the press last year and late the year before, there was a lot of talk about Jerome Powell doing what they called inverting the yield curve. And normally the inversion of a yield curve is a predictor of an upcoming recession. That's what people would often say. And this time, a lot of people say, yes, but this time it's different. And I have to actually put my hand up and say, I was one of those people that said this time is different. It's different because the Fed has got a lot of money on its balance sheet that they need to offload. The Fed has, they're still sort of trying to recover themselves from all of the money they had to push into the markets during the Great Recession. So, there's not going to be a recession. There's not going to be anything. This time is different. And for a totally unexpected reason, the people who actually decided to start shorting the market last year as a result of the inversion of the curve, because it actually inverted and then became normal again, and then inverted and became normal again. And that happened quite a few times. So a few people just took a position on. I wish that I had maybe just taken a small position on just in case. But those people who actually did that, for reasons that actually had nothing really to do with the economy, but something to do with an outside event, being COVID, actually would have made a tremendous amount of money from that trade. So that was
a completely different reason.
Completely different reasons, but it doesn't matter.
Well, maybe they had agreement with coronavirus, and so the timing was right. It might as well be happened. Well, we're living in a very interesting time. If it wouldn't be for coronavirus, it would be great. This coronavirus, it's a little bit spooky, I don't know. I got a message a few days ago from my friend who lives in Copenhagen in Denmark. He's a little bit older than I am, but still, what he wrote to me that thank God we had a great life. We were born in Soviet Union. We were able to immigrate. You in Canada, I'm immigrated to Denmark. We had a great life. We were born after Second World War, So we had a really fantastic life until a few months ago. Coronavirus struck, and unfortunately, I'm afraid it will be there for a long time. So okay, so we'll struggle with whatever is left, and there's nothing we can do to that effect. Well, we don't know really how serious is it, and whether it will leave us all or it will stay there for a while. I don't know. That's completely different issue. But now, the interesting thing is that life still goes on, and we have to get the best going for whatever we can. Okay, Zach, how are you?
Good. How are you guys doing?
Good, good. Thank you for joining us. So, since you just appeared, let me ask you a question. Tell us what's new and exciting. You're so young and at the same time experienced trader. So what's going on? How it works for you? What do
You're
you
not
do today?
you're not calling me old though, are you? You're not implying that because he's young I'm old. You're not saying that, are you, Sasha?
No, 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 no. You know each other, Zach. Here's
I,
Shakeel.
I don't think we've actually met, so good to
Yeah,
meet
we
you,
haven't
Zach.
met yet. Yeah, nice to meet you, Shakeel.
No, but Zach heard you quite a few times on different shows, so he's definitely
Yeah, I've
familiar with.
heard of your shtick, and yeah, so I've been busy at work going over stuff in the markets, and also I've been really happy to see my position in gold and various gold miners go for a little run.
Oh,
So
we
that's
just
good.
discussed that the gold mining company. So what mining companies are you investing?
I'm in Newmont Gold and Kirkland Lake Gold, along with also just the gold GLD, the ETF for like gold
Index.
itself
Yeah.
index. But on top of holding position in those things, I've been using options to roll out and up in Kirkland Lake Gold. So that's been really fruitful position.
What a percentage of your portfolio takes gold and gold positions?
Well, right
Approximately.
now, way higher than usual, just because of the crazy inflation and overvalue in the markets. Like right now, I'd say it's probably like I'd say like 60% of my total portfolio, and more than that of my currently invested portfolio, because I also have a lot of allocation in cash compared to usual.
You're a brave man. What can I say? I have only Newmont gold. I occasionally have also Barrick gold, but I think Newmont is a better company.
Yeah, much better company for a lot of reasons. And yeah, I've been following the miners closely for the last few years, and Kirkland Lake is one that I've been has been a big part of my portfolio since on the Canadian exchange. It was at about $17 a share not that long ago, a couple of years ago.
Mm-hmm. Well, you see, it's interesting situation with gold. Shakeel, would you agree that market generally, but I would rather say a gold or some stocks or whatever moves in the direction of at least resistance? So if the gold broke through 2000 and there is no resistance practically, there is nothing prevents gold from going to 2250 or maybe 2500 in the near future. What do you think?
Yeah, so unfortunately, I'm the wrong person to ask that question because I tend to be quite bearish on gold at times like now.
Mm-hmm.
And I'm bearish on gold because it's gone up. And I was bearish on gold, during the Great Recession as well. But I'm not going to start short selling it now. It's just that I'm waiting to sort of see how high it'll go, and then start trying to trade it coming back down. But I'll just actually address that, because that's something that a lot of people, when they first start out in trading, they learn about support and resistance. And one of the things that I'll say is that always remember what the market makers are doing. The market makers generally don't care what the price actually is. What they care about is that they can make the spread, that they can buy gold from you. I'm obviously being ridiculous with these figures, they can buy gold from you at 1,700 and they can sell it at 1,800. So if they can do that all day, they're going to make $100 an ounce. I know I'm being absolutely absurd.
Oh, you would put bid and ask and just make on a spread difference, right?
Absolutely. And so, you might come in and say, well, I don't want to pay 1,800 to buy gold, so I'll put my price in at 1,760, and the market maker thinks, well, I just actually bought some gold at 1,700, so I'll sell it at 1,760. That's what the market makers are doing. And so they're going to move the prices around until they can try and get a bit of an equilibrium behind the buying and selling that they're getting, so they're just making that spread.
Yeah, Shakeel, but it's all based on supply and demand factors, obviously, right?
Well, look, I think it used to be, but I think in today's world, it's changed a little bit from just simply supply and demand. Yes, supply and demand at a macro level will determine some things, but we've also started to see the, incredible impact that computerization and technology has had on the markets, and that algorithmic trading has had on the markets, as well as high frequency trading. And so that's going to have an effect on it as well, because the high frequency trading groups, they might know, for example, that it's quite likely that you have got a stop sell order just below an existing support range. So what they're going to do is they're going to drive the market down until it hits those stops. They're going to get all their orders filled, and then they're going to tick the market straight up because there's no resistance anymore. So, I don't think it's quite as simple as what you're saying there. However, again, what I would say to people is, and I think you alluded to this before, is maybe don't try and time the market quite as much. If you actually have a view that gold could easily get to 2,000 or to 2,200, I've even heard reports of people predicting it could get to 2,500. I will say that was also a report that people were suggesting those sorts of prices during the Great Recession. But if you actually think that that's something that could happen, mitigate some of your risk, but trade so that you make a lot of profit if that does happen, but you're minimizing your risks if it doesn't. That would be a good way of actually doing that. Options are a great way of being able to do that.
And that's what I've been sort of thinking about that. Right, if it hits, which it has with Kirkland Lake on the rolling out now, then I can take a relatively small amount of my capital that I put towards the option side of that and turn it into a huge return. But then, like you said, if it blows off as it could, then it's a very small position size in the grand scheme of things.
So one of the things that I would say about gold prices moving up today, this might sound like I'm going slightly off topic, but there was a senator, I believe, or a congressman, Ron Paul from Texas. Somebody will probably correct me, he's probably from somewhere else, but I know that in one of his Senate inquiries, he was, I think he was actually talking to Ben Bernanke, but again, I might have my facts a bit wrong on that. But I remember that he had talked about the price of gold relative to the price of oil, and that whilst it fluctuates, that's generally fairly stable. And I think that was actually quite an important point, is it's how much can you buy for 1 ounce of gold today compared to before, and how much can you buy for $1,700 today as compared to before. The reason why I might be more inclined to think that it's more probable that gold could hit 2,000 or above today is because we are inflating not just the currency in the United States, but almost all countries right now, and the ECB are inflating their currency because they're pushing so much more money out into the market.
And interest rates too. Interest rates.
They've lowered interest rates. In Europe, interest is in most of Europe, the interest rates are negative. Interest rates are at extremely low levels, and in almost every developed country now, by the time you account for inflation, interest rate, your real rate of interest is actually going to be negative, even in the United States. I think that that's going to put upward momentum and upward pressure on gold. But I personally don't. I'm not a fan of holding gold as a store of value. I think that gold, and that's just my personal opinion. There's no right or wrong on that. I just don't. I like to have something that I think is income producing and that has a yield. But the other thing I'll just say about the Fed in the United States is they've actually run out of places where they can actually push money into the markets, because they've already bought up all these bonds to try and free up some money. And so one of the things that they started doing a few months ago was they actually started buying ETFs, bond-based ETFs, to try and push money into the market that way. And so this is going to be a very interesting time, and it's a time, I think, for real economists, not people like me, but the real academic economists, to really debate about what the world looks like moving forward, because there's a limit to what you can do. There's only so much money you can print. There's only so much inflation that you can handle. There's only so much quantitative easing that you can do. And there are still countries, especially if we talk about countries like Italy and Greece and Spain, and many other countries in the EU, that they're still recovering from some of the QE that's occurred. And so once you've exhausted all of those avenues, what else do you then do? And that's going to be a very interesting situation, I think, moving forward.
Shakeel, but these countries are always struggling. They were struggling 12 years ago, and 10 years ago, and 5 years ago, and probably 25 years ago just as well. I just don't understand the European Union single currency euro. It's just amazing how such different countries, like if you take Germany and say Greece, how these countries can have the same currency, where German economy is a powerhouse and Greece economy is so they're doing okay, I guess, but they're so different countries, different economies.
Well, and this is I think one of the big problems with having a supranational currency. Because countries are different and their economies are different, and so normally you would experience a balancing effect where if one country's currency has declined against another. For example, I use the example of Canada, the Canadian dollar and the Australian dollar. At the moment, because the Australian dollar is, historically speaking, it's relatively low against the Canadian dollar right now. That makes investing in Australia a more attractive proposition for Canadians, because Canadians can get more for their Canadian dollars than what they could get before. Now, of course, when that situation reverses and the Australian dollar is higher than the Canadian dollar, that then means that the Australian dollar and the Australians are going to find Canada a more attractive place to invest in, whether it's real estate or business or whatever the case may be. And that's an overly simplistic way of putting it, but I'm only comparing two countries. But if you then have a look at the EU, this is something that doesn't work. And what you're saying is you're saying that the countries within the EU are borrowing money at different interest rates, but that's not necessarily in and of itself enough for them to be able to have real economic sovereignty over their own currency and over their own country. And this was something that Margaret Thatcher actually warned against quite heavily, whether you like her or you don't like her, whatever you believe about her political positions. This was one of the major things that she was talking about in Parliament when the question came about, whether to join the EU, whether to join the euro, as opposed to keeping the pound sterling.
Yeah, but Great Britain was able to keep its own currency throughout all the time.
That's right. So this was largely as a result, I think, of Margaret Thatcher and her successor.
You see, in old times, for example, Greek economy is struggling, so they could devalue their what they had, drachmas, I think. So they could devalue drachmas against German mark and to try to repair things this way. But today, Greeks cannot do that. So, as you say, they have to borrow at higher interest rates. So, in fact, the weak economy is being punished by higher interest rates they're borrowing. So that's not very pretty situation, right?
Well, that's right. And the thing is that the US dollar has this reputation, and it's one that I don't agree with, that the US dollar or the US government can never default because they can just print more money. Well, every country theoretically could. We trust that the US won't do that. But in my opinion, every country could. Australia has never defaulted either. But theoretically, there's nothing to stop the country from saying, oh, yeah, we're going to default, we don't care. it would be bad for the economy for a country to do that, but they could. One of the problems that you have is that you cannot have a situation in any of the current EU member countries that use the euro where they can actually devalue their dollar or increase the value of their dollar or do any of those things. They're only limited by interest rates, which is enormously difficult because, as you said, we have a situation where you've got negative interest rates in most of Europe, and then you've got high interest rates in places like Greece. What ends up happening, though, is that bond traders will often look at that and they'll say, okay, well, how much risk am I taking here? Because if I can short sell a German bond that's denominated in euros
and go long on Greek, right?
Go long on the Greek bonds, I can take the difference and I don't have any currency exposure. So if I was to try and do that with the New Zealand dollar against the US dollar, the New Zealand dollar historically, the last 10 years or so, again, current circumstances have changed, but historically the New Zealand dollar has actually had a relatively high interest rate compared to the US. So that was quite a good carry trade proposition, but you actually had the FX exchange rate differential that you had to worry about. And this was something that happened when you saw the massive devaluation of the British pound, probably 5-6 years ago, was that the British pound was being anchored against the Japanese yen because the British pound had a very, very attractive interest rate. It wasn't quite as high as Australia or New Zealand, but obviously a much bigger economy. And what you actually saw was when the UK lowered their interest rates, the anchor trades all got unwound at the same time. And you see this massive outflux of money from the UK. And again, those people who are better researchers than me will be able to research this and say he's got his figures wrong. But from memory, it was something like $5 or $6 trillion that actually exited the UK, in the matter of a week or a couple of weeks. So, these sorts of things do have big effects. And I'm just not sure that the EU, in its current the way the EU works at the moment and the way the ECB works at the moment, I just don't think that that's going to be sustainable. What you're seeing is countries like Germany and France having to bail out countries like Italy, Spain, and Portugal to some degree, Greece, of course, and then there's a number of others that are really struggling. But then where do they get the money from? Who bails them out? Well, then they've got to get the money from the ECB, and it just becomes this sort of perpetual, self-perpetuating downward spiral. So I definitely think the EU has got some great potential. You've got 750 million people that live over there. You've got a diverse economy. Collectively, their economy should be bigger than the US's is, in my personal opinion. But it's just not being managed correctly at the moment, in my opinion.
I fully agree with those points.
Yeah, go ahead, Zach.
And yeah, I agree with those points. And the part that really caught my attention when you're saying the whole thing about how basically up until this point, people had the general belief or assumption that, the United States will take care of things because they won't print money and that'll keep everything in check. And then now we're sort of seeing that kind of open some people's eyes that, well, maybe that's some lack of stability from a place that's supposed to be offering stability internationally. So I think it'll be interesting to watch sort of the fallout of that combined with the EU's mismanagement.
No, I think Zach, that the reason why there's this theory that the US could never default is not because they wouldn't or can't print money. It's because they could or can and will print money, as opposed to defaulting. If you look at the current debt situation in the United States, and to be fair to the United States, let's exclude the extra few trillion that they've had to put on their balance sheet, or arguably have had to put on their balance sheet because of COVID. Let's just exclude that. If we have a look at their debt at $21 trillion, that's for
23 before COVID.
23.
And with COVID, it's more 26 and 2-3 billions, trillions will be added anytime soon.
Yeah. So that's obviously very high. But even if we exclude, most of the COVID debt, just for the sake of what I'm going to say, 23, 24 trillion, that's a problem. the government's total tax take is around the 4 trillion. Sorry, it was around the 3 trillion mark from last year's figures, but they're spending around 4 trillion. So they've always got about $1 trillion shortfall. That exponentially increases as well. I personally can't really see how the US can pay that off other than to do a number of things. One of them is that they really have to increase taxes, which is something that I hate saying because I'm not a fan of high levels of tax, but increase taxes as a percentage of the GDP of the country. 25% is quite low amongst the OECD countries. I think it's the lowest, followed by Australia at 27%. But yet Australia and the US both have a progressive tax system. So to me, it's quite clear that that type of taxation system doesn't work very effectively. I think that there needs to be tax reform. But leaving that aside, increasing taxes as a percentage of the GDP is one of the things that they need to do if they want to be able to continue to provide the services that they've currently got. The second thing is I think there needs to be a limit placed on them, placed on governments as to how much money they can actually spend as a percentage of the GDP of the country. And the third thing is that they should try to if they're able to contain their spending, then they should be able to curtail the increase in their debt levels. And then over time, it might take 50 or 100 years or something, but over time you should start to see that debt become smaller and smaller because of inflation. That's the only way that I can really see them handling that. Now, if you then juxtapose that against the ECB and the things going on in Europe, it's so much more complicated because you're not talking about one country. And countries like Canada and Australia have some advantages and disadvantages, but one of the advantages that you have in countries like Australia and Canada, with the exception of Quebec, is that the states and the country tend to operate fairly similarly. Whilst there are some differences between some of the states in Canada, and there are obviously some differences between the states here. Here in Australia, for example, we have income tax, which is paid to the federal government, and we also have a GST, a goods and services tax, which is on all the goods and services that you buy. That money is collected by the federal government on behalf of the states and is then redistributed to the states. Whereas in the United States, you have a situation where you have your federal taxes, you have your payroll taxes. Each state has its own taxes, whether that is income, like in California, or sales tax, which also California has. Nevada has a sales tax, but no income tax. Texas has different taxes. So you've got all these different states, and then within the states, you have all these different, councils and localities that put their own sort of taxes on, and you end up with this enormously complicated tax system that I think makes it very, very difficult for them to, as a country, at a federal level, be able to deal with all the issues federally. And if you have a look at if you have a look at a state like California, their debt levels are extremely high. Last time I checked, they were sitting up around the sort of, I think they've got 700-800 billion or something. They're probably up around the $1 trillion mark now. Okay, they've got a population of 40 million, so the population of California is more than the population of Canada, but that's problematic when you have those sorts of debt levels. So that's definitely something that I would keep an eye on. The point to all of that, the point of me saying all of that, is when it comes to investing, I would be looking for things that aren't cash. I'll be looking for things that I think are going to hold their value or increase in value versus cash. And that sort of ties into what I was saying before about relative value. Okay, if you don't want to do relative value trading between the Dow Jones and the Nasdaq index, or the S&P 500 versus the FTSE 100 in the UK,
or Russell 2000, for example, you can leverage,
or Russell 2000, or whatever it may be. Remember that when you are buying something, when you are buying a share, you are actually still trading relative value. You're trading relative value for the $10,000 worth of shares that you bought versus the $10,000 in cash that you swapped for those shares. So your hope is that those $10,000 worth of shares that you've bought are going to enable you to do one of two things: either buy more than $10,000 later in cash, or that you're going to be able to convert those shares into something that you can buy that $10,000 you wouldn't have been enough to buy. So if that car that you want to buy today is worth $10,000, and next year the car's worth $11,000, but your shares are worth 12, then you're actually able to convert your shares, get the car, and still have $1,000 left over. Whereas if you left it in cash, you'd be $1,000 short. So it's still a relative value proposition, and that's what people, I think, need to really think about when they're trading the markets, is relative value.
And what's the position that goes off of that I was considering for a while putting on, that was a concept, was putting on a small percentage of my portfolio, but a short position on the Canadian dollar.
Against?
That would be, I would just go short the Canadian dollar itself, but then I would go long my positions in gold, and I would see, because gold, one, it has the longest.
Sorry, so when you say short the Canadian dollar, against what currency? Against the US or against the
US? Yeah, against the US.
US.
That would be the currency pair. And that one would just be betting on the Canadian dollar not doing well, but then against it, like separately on the other side of a separate trade, but that I see attached to it, is I see people putting their money into what are viewed by some as safe haven assets. And also just with the historical stuff on when basically any commodity, but especially precious metals, if they, one, the base is like never been seen before at this level that it had, but then also when commodities, more so than equities, when they break to all-time highs, they tend to run away pretty hard compared to even though there is a little bit of the trend is your friend stuff and everything, it's in commodities historically seen magnified many times multiple.
Commodities pairs trading does tend to trend more frequently. I'll just say in relation to the Canadian dollar situation that you're talking about there, my personal preference when I'm trading the Canadian dollar is I try to avoid trading the Canadian dollar against the US. And the reason why I try not to do that, I will do it from time to time, but the reason I try to trade the Canadian dollar against other similar sorts of countries such as Australia is because the US and the Canadian borders obviously are right there. The majority of Canadians live, pretty close to the border. I've got family in Canada, and they'll cross the border and fill their cars full of petrol or gas, as you guys call it over there, and then drive back across the border because it's a little bit cheaper in the United States. I think that what you see in the US and Canada is a very quick and very fast correcting situation when the economies get out of whack. And you saw that. I have a very close family connection to Whistler. And when I went up there last time, I was looking at some of the beautiful properties that were up there, and my uncle was actually saying to me that during the recession there was a great number of Americans that came over and bought up all of these properties for quite cheap prices because the US dollar was so high. And that's the kind of thing that is going to happen between Canada and the US. It happens very quickly. When the Canadian dollar is really high, all the Canadians go down and go for holidays down in the US, and that self-corrects very quickly. It's obviously a little bit more difficult to see that happen. It's going to take a little bit longer to see that happen between, for example, Australia and the US, because it's a 17-hour flight. It's not a half an hour drive. So that's why I would be a little cautious about that. One of the things I would love to see actually happen, there is a thing called the DX, the dollar index, which is the US dollar against an index of other major world currencies. I actually think it'd be very interesting to see them create those sorts of indexes with maybe the top 8 or top 10 currencies, so that you could actually see how they're all moving relative to the other currencies in the basket.
Yeah, that's an interesting approach. I would like to add something to what you said earlier. First of all, remember you mentioned that the European Union, with all these problems, discrepancies, but it's still a huge market of 700 million people. It's very important. There is an economic theory suggesting that in order for any single economy, whether it's one country or a bunch of countries, functioning really well and sustainable, when the population is at least 350 million people or more. So obviously European Union is one of these entities, China, India. They're all over a billion people. Obviously, they are. Now, the other entities, such as, for example, Russia has great aspiration to become a world power or so on, but the size of their population restricts it from functioning as a major economy. It's only 140 million people. So Russia needs to create international alliances and grow through this way, but they're not doing a good job at that. Countries like Australia and Canada obviously need alliances. Okay, Canada geographically is very close to US, so it's fairly easy, and that's what's happening. It's aligned with US economy to a large degree. Australia is in the proximity of Asian market, so it can do really well by aligning itself with Japan, China, India, and all countries in the sub-Indian continent. So these countries also can prosper relative to many other countries. Now, another thing is I would like to offer is that your example of, say, $10,000 cash. So what you can do, okay, so we know that you will take it to the bank because they will pay you 1% a year. So you will get for your trouble
$100.
$100. Okay, you'll get $100 with no risk, so on. And okay, so you are looking at any other properties that you can acquire for $10,000, whether it's gold, stock, or just name it. So it will create anything more than $100 in 1 year. So in my example, having exactly that idea in mind, I acquired stock of a company Altria, which pays 8.2% dividend. Actually, it's increased to 2 weeks ago. It was paying 7.5. Now it's paying 8.2% dividend. So now instead of $100, provided that stock will stay the same, it will not go higher or lower, whatever. So I'll collect now $800 or something, right? So it's 8 times more than if I will log this $10,000 in a bank. So is this extra $700 worth the risk that I'm taking? Obviously, there is a risk, regardless how well the company is doing and so on, and increased dividend. It will be there for quite a long time. So I'm doing another thing with that. I'm also selling from time to time covered calls, even to increase my income from ownership of the stock. So to create even more, and that's okay. I treat it as extra income, but I also treat it as extra protection. That where the stock is now, say, 41 something and a half maybe, so creating really a cushion that stock may dive to 35. Who knows? I don't think with a dividend like this it will go much lower, because if it will go much lower than the dividend, provided that it's not going to be decreased, it will pay, I don't know, 10%, 12.5%. I mean, I don't think it will stay that low for a long time. So that's one of the ways of dealing with this problem. What is a good replacement for cash? So instead of having cash $10,000, you'll do something else which will hopefully increase your payout.
Sure, but again, as you pointed out, the share price could fall. The board of directors might decide to suspend dividends or cut dividends. There is obviously a substantial amount more risk doing that than what there is putting the money in a bank or by buying a government bond.
Absolutely.
But of course, that combined with covered calls is a way to get some pretty reasonable returns. And you just have to be prepared to take the risk when you're doing it. I personally would say, as we discussed the other day, I have a few issues with covered calls by themselves. It's not a bad strategy to use from time to time, especially if it's on stock that you already own and stuff like that. But I definitely think that using embedded spread trades as opposed to just a covered call is probably a safer way of doing it, because you're not going to miss out on the massive upswing either. You're not going to have the stock call to get away from you. So I think that's probably a better way of doing it. And of course, that those covered calls are helping to reduce the price that you paid. If you paid $50 for the stock and you're getting $2 every time you write a covered call, that's sort of paying off the stock for you as you go. There's taxation implications, and I won't get into that because obviously there's, different countries have different rules and all those sorts of things. But there's also those things to take into consideration. But the other thing I'd say is that I'd be very cautious about putting my entire portfolio into just one strategy. I'd be wanting to have multiple strategies at the same time.
That's what I used recently, a few days ago, on the Newmont gold. What I did, I sold puts. My calculation was that if I will not exercise, I'll just keep the premium. However, if I will exercise, I will acquire stock, which I'd like to buy anyway. I will acquire it at substantially lower prices. It's trading today with around, $70 some, and my price will be only slightly over $67. So I wouldn't complain if I will get exercised, but quite unlikely. So this strategy can work. Also, there is one stock which I'm also trying to acquire using the same strategy, ibmtv. It's a pharmaceutical company paying 5.5% dividend. Stock is very good. It's now about 93.5. I sold calls, $94 calls, and I got premium almost $3. So at the worst case, I will get stock at $91, paying 5.5% dividends, and we'll see if I will get exercise. I sold August 21st call, so we'll see. I don't know.
It's an interesting strategy. There's a thing that you may or may not have heard of, and for the viewers, there's a thing called the dogs of the Dow, and that's actually the high yielding or the highest yielding stocks within the 30 components of the Dow. And I actually did quite well a number of years ago trading Verizon and AT&T because they not only did they come with a really nice juicy 5.5–6%
exactly.
Yield, but actually the stocks went up as well, which was great. And what I did was I actually took some protective puts over the position rather than doing an income-based strategy. I took some protective puts over the position, and as the stock moved, I rolled my puts up, and I kept doing that until I reached a point where the amount of money I'd expended on puts plus the amount that my stock was worth put me now in a risk-free position. AT&T could go bankrupt, highly unlikely event, but they could, and I wouldn't lose anything. And so now, because obviously the way that I trade, I can borrow money against that position and put it into something else. I'm borrowing money at, I can't remember what the rates were back then, but let's say I'm borrowing money at 1%, I'm receiving 5.5%, so I'm making a 4.5% a dividend yield, as well as receiving any potential increase in the price of the stock. And from memory, the stock actually went up something like 25%. I'm thinking about AT&T here. I think it went up around 25% over 18 months. So that was quite a good trade. And I think with trading, there's many different ways of skinning the cat, so to speak. So I don't know if you have that saying over there, but we have the saying here. So.
Well, listen, Shakeel, we have to be mindful. There is no single strategy that works all the time in any market. We all know that. So obviously in this, however, my point is that in this situation with the rate of effectively 1% a year, that's what you can get in your bank or anywhere, even by looking in some CDs, you're almost forced to become investor, trader, or you can call it anything you want. Actually, I have a friend of mine. He is let's say he's buying stock, and in first 15 minutes he already knows he's going to lose money or make money. So if he's making money, he's selling it in 15–20 minutes later. He made a few $100 here and there. He's happy. Now, if he is losing money, now he becomes a strategic long-term investor. So now he starts to study about the company. He reads the annual reports. He knows about that stock as much as anybody else. He can go on tour in the United States and lecture about this company. He knows absolutely everything what is there to know, and he's a long-term investor. So that's why you cannot qualify. Okay, this guy is an investor. and this guy is a trader. You have to combine both.
But I think very good traders, and as people become more advanced with options, what they can do is they can take a directional position, and then when it goes against them, they can say, okay, that position's gone against me. I was only planning on holding that for a week, but what I'm now going to do is I'm now going to use options to try and recover my losses and recover that. And I think that's quite a skillful play. I want to address something that you talked about with Russia. It's very interesting because the Chinese yuan has gone up, and the wages in China has gone up, as have living standards, to a point now where China is not as competitive in the manufacturing sector as it used to be. And you see a lot of those jobs now going to countries like Bangladesh, some of them going to India, some of those other countries. And it's interesting that Russia hasn't really, they haven't really made the alliances as yet to be able to bring some of those jobs there, because I think Russia has a great potential. I know that there is still some overhang from, World War II and all of those sorts of things, and there are questions about corruption and all that kind of stuff. But Russia's a country that's improving. These things don't happen overnight. Russia's becoming a much safer country. Russia's becoming a more stable, with the exception of some of the spats that they might have in the United States from time to time, and the annexation of Crimea that caused a bit of international turmoil. Russia is becoming a more stable country. And a lot of people, I haven't actually had the pleasure as yet of going to Russia. I did get the chance a few years ago, and unfortunately, I just couldn't quite make it over there. But I would love to go. But from what I understand about Russia, most people sort of look at Moscow and look at St. Petersburg, and that's all they really see of Russia. But Russia is a very, very big country. There's a lot of very rural communities, and they need jobs there as well, and wages there can actually be quite low. They also have a very big agricultural sector, and they have the potential for much more agricultural sectors there, and much more growth in those areas. So I think that over time that will happen with Russia. But just talking about sovereign defaults as well, and just something that the viewers may not know, the two of the three Nobel Prize winners who created what they call the Black-Scholes model, which is the sort of main model that options pricing is based off. They set up, with a couple of other guys, they set up a hedge fund called Long-Term Capital Management, and they were having exceptionally great returns. They were doing very, very well.
I remember.
One of the things that caused their huge demise was that they had Soviet bonds in their portfolio, and when the USSR stopped being the USSR and became Russia, Russia said, those bonds on the USSR, what's that got to do with us? It has nothing to do with us. And so this, of course, caused quite a calamitous event. But again, I think that it'd be very interesting to see what happens with Europe. I mean, with Brexit occurring, and I think that there's actually a lot of people in Europe that are quite unhappy with the opaqueness with which the European Parliament and European Commissions actually work and how those rules are made. And that does cause a lot of people to feel as though, not just in countries that we know are likely not to be particularly happy with the EU, but even in countries like Belgium, where EU headquarters are, even in countries like France and Germany and Austria, there is this sort of underlying feeling sometimes of, why is somebody in Brussels telling me here in Austria, that I can or can't do certain things? And that's beginning to fester a little bit now. It'd be really interesting to see if the ECB, in my opinion, sorry, not the ECB, if the EU Commission and Parliament doesn't reform itself, I think that I'd have grave concerns for its future. And that would be a sad thing to see, because after World War II ended, the idea that, a young kid from Spain could say, hey, I'm going to take a gap year after school. Before I go to university, I'm going to, backpack around Europe. I'll take a couple of jobs as a bartender. I'll be a cleaner or whatever. That's a great opportunity. American kids love doing that. A kid who's born in New York goes and does a bit of a trek and catches the Amtrak all around the United States and does that for a year or two and explores the place. That's a really great thing. And to see young people not being able to do that, I think would be a shame. But they definitely have to do something about reforming it. And if they don't, and the EU ceases to exist as an institution, where would that leave the ECB? And where does that leave the trillions and trillions of dollars that are sitting on the ECB's books? Who's going to take responsibility for that? I'm not suggesting that we're going to see the same thing as what we saw with the USSR versus Russia, but certainly I think it's an interesting dynamic.
Yeah, Shakeel, but still, it's such a pleasure. I remember a few years ago, I flew to Nice, rented a car. Now, my wife was playing in Turin, in Italy, in a chess Olympiad. Okay, so I rented a car in Nice. I drove to Turin, and I was ready to cross the border between France and Italy. And I was saying, okay, where's the border? I'm driving, and like in France, all the signs are in blue. I kept driving, and all of a sudden I see that the signs now in green, which is Italy. So I realized that actually there is no border to cross. You just driving, you drive in France, and now you drive in Italy. It's such a pleasure. And then you go off and you go to farther. We went to also Switzerland. Now, Switzerland is different because there is a border, but it's kind of a border because you just stop and they show you just keep driving. It's nice.
People there, and sometimes there's not. That's what's so interesting with the borders between Switzerland and Austria. Between Switzerland and Liechtenstein, nobody really, I don't think I've ever even seen anybody there, but I actually was stopped once between Switzerland and Austria, and it was great because the day before I didn't bother to bring my passport. I'd forgotten I left it in the hotel back in Zurich, and I was stopped coming back into Switzerland, and I thought, my goodness, thank goodness this didn't happen yesterday because I didn't have a passport. So what was I going to do?
But same, we were in Munich, in Germany, and we took a train. It's about an hour and 40 minutes to Salzburg, Austria. I mean, you're like in the same country. There is no border crossings. There is no documents to be shown. Nothing. Just there, take off here, and then come back. It's just fine. Anyway, Shakeel, we have a wonderful travel show now.
As COVID's over, I'll
let's hope that COVID will.
And that's why I think that Europe has great potential collectively. They have great potential to be, a big world kind of power and a big economy that could really rival the economy of the US, and that there should be a lot more trade going on between Europe and the US as well. So I hope that the EU, the European Commission, the European parliamentary process, and the ECB are able to just reform themselves a little bit, because there's so much untapped potential in Europe. Same as Russia, and for a large part, same as India. I think India is reforming itself, and I think India is becoming a much more sort of freed up economy and that sort of thing, but it's not there yet. But I think, look, with COVID, we have experienced something, not everything about COVID has been terrible, okay? Yes, we have had some tragic deaths, and of course, there's nobody celebrating that. But it's also enabled things like what we're doing right now. We're in 2 different countries. On Monday nights, we're in 6 or 7 different countries where, the speakers are coming in. People are able to communicate differently. People are able to work differently. There's a lot of jobs that people are now able to realize, hey, I can actually do this job from home. We've actually seen the rates of pollution go down for those people that care about the environment, where people aren't having to drive into work, that they can do a lot of their work from home, or they can work part-time from home and part-time from the office, and all those sorts of things. And technology's out there, things are happening. I think that COVID gives people the opportunity to be able to say there's some real strength in us as human beings. And I think that one of the things that history has always shown us is that it's normally when humans are pushed to the brink of sort of destruction that we actually come out with some really great things. And so I'm actually quite hopeful for the future. I do think, there's going to be some economic tailwinds, of course, but I think we'll recover pretty quickly once COVID's sort of over. I think we're going to recover very, very quickly. I think you're going to see people jumping on planes and traveling and going out to restaurants because they've been cooped up in their house for a year and they haven't been able to leave. And now all of a sudden they're going to be able to. So I think that there's going to be a massive surge in the economies of most countries. And hopefully, if the government, doesn't do what they always do and act like idiots, hopefully the government will take some of that extra revenue and start paying down some of the debt that they've all accumulated over time.
Excellent. I would like to explore one more subject. Zach, I'd like to ask you a question. Do you play chess?
I have only played a couple times, but that is definitely something that I want to learn about.
Excellent. Because on this coming Saturday, we will have a chess program, and there are three subjects: how chess correlates to arts and to investment. Now, we will go and explore it on Saturday. However, I'd like to mention two things about chess and investments. One thing, what's common between chess and investments is chess is a game where if you lose a game, there is no one to blame except yourself. You cannot say, like in hockey, oh, your coach was terrible, you played in a wrong, your guys didn't support you, let's say you're a center forward, so the wingers were not so good, or so on, they didn't give you a pass, or so something else. In chess, there is no such thing. You are the only one playing your opponent. You see the board, you have the same number of pieces as your opponent, so it's only you are one to blame, same as in investments. If you made the wrong move and you selected the wrong stock, or your strategy is not correct, or so on, and let's say you lose some money. Is there anybody to blame except yourself? You tell me. No?
Yeah, that is interesting. I want to learn.
Yeah. Shakeel, what do you think?
Well, I think as far as the investment side, on the chess side, if Jim Eade's watching, if I lose a game of chess, I'll blame it on him because I've been reading his book. So if he's watching, any losses I have are his fault, and any wins that I have are mine.
All you, yep. That's my strategy too for a lot of things.
But no, with investing, look, I agree with you, and this is the point that I think I brought up a couple of Mondays ago about, look, people put so much trust in pension funds and all these things, but when you ask them, okay, well, if your pension fund is your life savings, if all you've got is your house and your pension fund, tell me the name of the person who's running your pension fund. Who is it? Do you even know this person? This person, this nameless person who's in control of your life savings, you don't even know what they're doing. I mean, this is the sort of thing I think people have to try and take some responsibility for it. And this is really, to go back to the old system of social security, which, was tried in the US and has been tried in Australia, where, you would qualify for the old age pension. I think Canada has the same sort of thing. You qualify for the old age pension. And in some countries, your pension may be a little bit higher if you've been a higher income earner because you pay into it. But personally, I don't trust the government to do very much. I mean, they tend to do a pretty poor job of just about everything they touch. We need to have a government, but, we don't have to like them. And I'm not a partisan. I don't care whether it's the left or the right that's in. They're all politicians. I don't have much faith in our political institutions. And the last thing I want to do is to hand over the power to them over what kind of lifestyle I will live at the end of my life, at a time when I'm going to be the most vulnerable, the time when, I've worked my whole life. I've worked 40 years. I mean, I would hope that I'm not going to be in that position because I run a couple of hedge funds. I'm 36 years old. I should be okay. But for the everyday person that just says, look, I'm going to go get a university degree. I'm going to go get a job. I'm going to work 40 years and I'm going to retire. They deserve to actually have some financial security. And I'm not sure that I would entrust that to government. And I'm not actually sure. I know I shouldn't say this. I'll end up with a whole heap of emails from pension fund managers in my inbox. But I'm not sure that we should just blindly trust pension funds and similar types of funds either, because we don't really know what they're doing. They are oftentimes under a lot of government regulations, and sometimes, some of them have got mandates. So they might be mandated, for example, to always have 90% of the money that they have invested with them in shares. Well, what if, as a professional, I mean, normally these guys have got committees that make decisions, but what if right now if things are just so tumultuous that you just don't want to, that you think the safest thing to do is just to take everything out and just keep it in cash for a month, just for a month, just until you can reassess where things are going. Now, I know, well, first of all, I wouldn't talk to my clients directly, but if I were to talk to my clients wouldn't care what I did. If I said to them, look, I know this is going to sound crazy, but I just want to liquidate everything we have in our account and just keep it in cash for a month. My clients would just say, well, we've entrusted you to make these sorts of decisions. Yeah, no problems. But if I'm mandated where I'm not allowed to do that, that's a problem. And oftentimes those types of situations come about not because of good or bad decisions made by pension fund managers. Oftentimes those decisions come about because of government regulations. So that's why I would definitely say that even if you're just starting out and you just want to go and buy a few shares and maybe try a few option strategies and stuff like that, just start and just learn. And you don't have to do it full time. Use it to supplement your income, learn a little bit more, and direct it yourself, because I don't think you can rely on anybody else as much as you can rely on yourself. And that includes me. Don't ring me up and say, hey, I want to put some money in your hedge fund. First of all, you can't. Okay, that's not the type of hedge funds I run. So no, to the viewers, I'm sorry, you cannot invest with me. But even if you could, don't just blindly go, well, look, I'm going to give you my life savings and you go do what you want. No, manage it yourself to some degree. Make sure that you are controlling it a little bit and you're directing it a little bit so that you have some control and you've got some responsibility, because ultimately whoever you want to blame for it, if I lose the game of chess, I lost the game of chess. I can blame Jim Eade, I can blame a bad coach, I can blame whoever I like to blame, right? But the reality is I lost the game of chess and that was the result. It's going to be the same thing in your retirement years. If you don't have anything because you've blindly trusted other people, you can blame government, you can blame the pension fund manager, you can blame the banks. The reason why interest rates are so low is because a lot of the risks that were taken by the banks, they've had to lower interest rates, which effectively has subsidized the banks with very, very cheap money at the cost of all those people who are in retirement who are getting a very nice 5 or 6% interest rate and were able to live off of that. So, you can blame the banks, you can blame whomever you like, but ultimately it is you that has to live with the consequences of it. So that's why I think it's really important that people pay attention to investing.
Very well said. Before we will close our show today, which I enjoyed tremendously, and thank you both. I would like to ask you any interesting trades you've done in the last day or two. Shakeel, you are a professional. You may not answer that if you don't wish.
Yeah, I'll let Zach go first, and
Okay.
and then I will.
So as far as trades that the fund I work at made, obviously I can't get into detail on that.
No, you personal.
But on my personal account, in the last few days, it's just been keeping on what I've had in place for a little bit, which the positions in the gold miners and a couple financials that I think are undervalued. But for me, compared to my usual allotment, like I said, I'm way heavier in gold than I'd usually be, and I'm also way heavier in cash than I would be if the markets were attractive. But I think at some point there will be a correction, and even though you don't want cash as an investment, it's not a good thing over the long run. If there aren't attractive opportunities in the market, then obviously it can, in situations, be helpful if you give yourself the opportunity to have a solid cash pile to deploy when opportunity does arise and you pounce on it.
So you keep your power dry when the right opportunity will show itself. I've initiated just one new position today. Of course, you know this company Netflix. And what I've done, I've looked at their chart and what the business model. Of course, there's nothing much new to learn. However, the stock is about $500, slightly over $500 a share. So I've initiated position where simultaneously I've sold September 460 puts and acquire 450 puts. So essentially, there is a $10 spread. I did just 5 contracts, but still, it's quite interesting because what I believe that the stock will be around 500 or even a little bit lower. I think I will keep the spread, the premium.
What was the credit that you received for that, Sasha?
How much I paid? How much I was paid?
What was the credit? Yeah.
Oh, hold on. I'll tell you in a sec. I was paid. Where's Netflix? $2.40.
Okay, so basically you're risking $8 to make two, which is a 25% return on your money as long
No,
as.
wait a sec. $10. I think I will keep. As the difference is $10, so I cannot lose more than $10, right?
Well, no, you can't lose any more than 8 because you received a $2 credit.
Yeah, 40. Yeah, so 760. Okay.
So that's a 25% return on your money as long as Netflix doesn't go below 460. So and Netflix can be volatile from time to time, but those are the types of trades what Sasha's just talked about for the viewers. That's called a bull put spread. And those are the types of trades that I used to say to people when they were first starting out. Look at those types of things because there's limited risk. You know how much your risk is in advance, and you can sort of have a play around with those and that type of thing. And just again stick to some of the companies that and you can do quite well from that. And it's a good starting point. And I'll also say if you are just starting out, be prepared to lose a little bit of money when you first start out, but don't consider that a loss. Consider that paying for your education. Because if you go into it and you say, okay, before I go and put $50,000 that I've saved up or $100,000 that I've saved up into the markets, let me just risk a few $1,000s. And maybe after I pay brokerage, because my positions are going to be so small, I'm not really going to make anything. But what you're doing is you're actually paying for your education. And it's an education that you're getting that you can't get from reading books, from going to seminars, from watching lectures, from listening to us. Some things you have to learn just by actually doing. And I definitely suggest that. As for me, so I do trade the US markets quite heavily because I have been a bit distracted lately because I've been dealing with some stuff in Singapore. So what I've done is I actually did a few trades on the Australian banks. So I have seen the Australian banks fall quite a bit over the last week. So I've actually picked up a few positions there and have done pretty well. I actually took a short position on one of the banks that gave me quite a nice profit. This is on my personal account that I'm talking about. And one of the things that I have to say, I did actually get this one wrong, but I had plenty of time. I thought that natural gas was quite low when it was getting down around the $1.80, $1.75 mark. So I actually took some September futures contracts over that, and I also took some call options over that. And it promptly proceeded to flatline and then fall down to $1.60. And I'm like, no. And I actually was thinking it would break its high and maybe get into the $2.30 and maybe even $2.40 mark. And finally, actually, last night and the night before, it actually did start to make a big move up. And at the moment, it's currently trading at just under $2.20. So that was quite a nice trade for me. I had a pretty reasonable sized position on that. So I'm pretty happy with that. And I'm looking at my account at the moment, and it looks like the call options that I actually had on that stock are likely to be sold tonight with my resting order on that. So natural gas was one of those ones I just thought was too low. And then I was reading the news, and of course, not being in the United States, I don't really know what's happening with the weather over there, and I don't really know what's going on. But it just seems a little bit low to me at the time. So.
Your advice not to be scared to lose a little bit of money. This is a famous story, again related to chess, because I know chess quite a bit. There was an old, he passed away many years ago, very well-known grandmaster in Russia by the name Levenfish. and he was doing a lecture in Moscow Central Chess Club, and one amateur chess player, he walked to him after the lecture, and he asked, "Dear Grandmaster, what would be your advice? I'm not really that strong player, but I would like to improve my game. What do you advise me to do?" He says, "Play game for 1 ruble each game, and you will see how you will improve very quickly. You will keep losing, and you will start think a little bit better what to do not to lose the game. Because if you lose, you have to pay ruble." So the
But,
same.
but, but I do think that the idea of you know, there's the old saying, you know, everyone's a genius in a bull market, right? Because pretty much anything you do is going to make money unless you short the market. The real trick to it, I think, is being able to recover from losses and keeping a cool head and going, okay, what is my position and what am I going to do about the position? And that's really the best education you get early on is going, okay, well, this position's gone against me, so what do I do about this position now? Do I leave it on and just hope it recovers? Do I do something else? You know, what is it that I'm going to do with the position that I currently have? And there's all sorts of different things. I mean, there's an option strategy called a stock repair strategy that's just designed to break you even when you've bought shares and it's gone against you. And it's one that, you know, you can sort of keep putting on and hoping that the stock sort of comes back a little bit. Which, you know, if you're unfortunate enough to be an Enron stock or something like that, well, you're not going to get your money back on it. But there are certain things that you can do to help to mitigate some of your losses. And that is just as important, if not more important, than actually the profits you're making. It's really important you know how to handle your drawdowns, how to handle your losses, how to handle everything. Because I don't care how good you are, you're never going to be correct 100% of the time. And it's really important that you actually work out how to manage that position. I was watching your good friend Gary Kasparov on I've gone mental blank now. Is it Master Series or whatever? He's got a chess thing on there, and I was watching him, and that was one of the things that he said. You know, in some of his chess stuff, you know, he said, look, before you just sort of concede and give up the game, just take a breath, have a look at your position. You know, see what else is there, see what's going on, you know, that sort of thing. And of course, I would never compare myself to him or to you as a chess player, but you know, I think that there is a certain wisdom in that. This is why, you know, when we talked about bullet chess, you know, bullet chess is fun because, you know, I can do it when I'm half asleep or I'm, you know, at the doctor's surgery or something and I'm waiting to see the doctor or whatever. You're on the bus and you just kind of, not that I've caught a bus for years, but you know what I mean. You know, you can just sort of play a quick game and it doesn't really matter too much and, you know, nobody cares. But when you are actually playing a proper game, you know, it's important that you sort of take that step back and think about, okay, well, what are my options here? What are all the choices I could make, and what's likely to give me a good outcome? And I think there's also an element of psychology with chess where you actually are assessing what is my opponent likely to do. And so if you really want to mix it up for your opponent, you play a haphazard style. You'll play one game really aggressively, especially if you're in a tournament. You'll play one game really, really aggressively, and then the next game you play really defensively so that your opponent has no idea how you're going to play it. It's really hard for them to predict what sort of moves you're going to make. Now, that's not going to work quite as well in the finance markets because you can't sort of psych out the market. You can't stare at the market and go, I'm gonna psych you out until you do what I want you to do. Of course, you can't do that, but you know there is an enormous amount of tools that you have. The last thing I'll just very quickly say is a lot of people feel very disadvantaged when they go up into the markets and they think, oh, there's somebody like Shakeel in there who's got mega amounts of money going in and out of the markets at any given time. Like, how do I compete with them? Well, the answer to that is quite simple. You have certain advantages that I don't have, and one of them is you're much smaller than me. Right. So if I'm running, and not just me, let's say I'm a big hedge fund and, you know, my hedge funds are relatively small, but, you know, say you're a big hedge fund and you're managing $100 billion or something, and you want to buy $5 billion worth of stock. Well, that's really hard to do. You know, first of all, you've got to make sure that you don't go over the limits where you have to declare that you are now a major shareholder of that particular stock. Then you've actually got to try and acquire the stock without moving the market. You know, and then eventually when you make a profit,
accumulate sizable position, you have to either sit on a bid or just slightly raise it, unless you want to go all in and your stock will rise just because of your purchase.
Well, exactly.
And then the liquidity when you want to get out too. If you're too much of a shareholder, that's an issue too.
Exactly. So you've got all of those issues of how to get in and out. And so the reality is you can get in and out, of course, but it takes a lot longer to get in and out. Whereas if you own $75,000 worth of shares in ExxonMobil, you're out. It's going to take you 2 seconds, you're out. But if you own $75 million worth of shares in ExxonMobil, it's going to take a bit more work. And so that really does give people the opportunity to look for certain things. The other thing is that for me personally, because I generally do this in the hedge funds, I have to do it. I have to stick to big companies, okay? I can't go to the smaller companies. And that suits you pretty well because I'm not good with the smaller companies anyway. Well, yeah, exactly. There's oftentimes no liquidity, but oftentimes no liquidity or very little liquidity can be something that's quite a profitable play if you can get in. So one of the smaller trades that I did, one of the trades I did on a smaller company, and this was many, many years ago, was I picked up stock in Sprint. I don't know if they were Sprint Nextel at the time. I think they were just Sprint at the time. And I picked up the stock for $2.20, and over about 18 months, got out of the stock at just over $6. So no, I'm lying. It was just under $6, but it actually went just over $6, and I got out just a little bit early. But that was a fantastic little trade. And on my personal account, maybe I would, I could still consider doing those sorts of things. But, for the everyday person, you can do that so much more easily than some of the bigger guys can. And, when I talk about relative value trading and long short and pairs trading and market neutral trading and all that kind of stuff, that's often because that comes from a place where I'm having to do that anyway. And so it makes sense for me to do it on my personal account. I still have portfolio margining on my personal account. So there's still a lot of things that I can do in my personal account that the everyday person may not be able to do. And so, that's why I trade the way that I do. But, stick to things that start somewhere and kind of build up from there is the things that I would say.
Excellent, Zach. And what you're up to, any trades in this week that you're considering?
I'm going to just examine all opportunities that arise. But right now I'm pretty much... for the most part, not actively pursuing any specific leads, but obviously I'll be scanning the markets, looking for any things that pop up that reach out to me. But right now I'm in the mode of just sort of staying with the positions I'm in. And other than that, really just staying the course with those and waiting for different opportunities to arise and then pouncing. But yeah, a few things that I might look into, maybe a couple. Just volatility.
An interesting scenario at the moment for those of you that are watching the markets. Just remember, please, the indexes versus the ETFs that hold those indexes do move a little bit differently.
Yep.
But if you actually have a look at the 3Qs, which is the Nasdaq ETF, that's up about 33 basis points, whereas the IWM, which is the Russell, is up 1.66%. So you've got about a 1.3% differential there. That's the sort of stuff that I can talk about where it can be very easy to trade those sorts of things to come back together. If you think that the Russell 2000 being a much bigger index, NASDAQ being a bit more tech heavy, will that come back, or will it get, will that gap get bigger? Those are the sorts of things you can look at. Also, if you have a look at the Dow Jones, you can actually see some pretty impressive things. So, like for example, at the moment, you can see that Disney is up 9%. Whereas the Dow Jones itself is only up 1%. And so that's something where you might look at that and go, well, has Disney gone up too much compared to the rest of the Dow Jones index? Before you start just blindly going, well, I'm going to short Disney and go long the Dow, or I'm going to short Disney and go long, some of the companies like down here at the bottom, that'll be Walmart. Walmart's down almost 2%. should I just trade that and try and make a 10% difference, and that'll take a couple of days? That could be a very good strategy. Maybe, maybe not. Firstly, get on Google, look up what happened with Disney, find out if anything really incredible happened today, and maybe you want to compare Disney to another entertainment company as opposed to another Dow component, that sort of stuff. But there's all the sorts of things that you can look at doing, and you can do things even with options trading there, Sasha, where you might say, well, look, I might actually do covered puts as opposed to covered calls across Disney, and then do covered calls against Walmart and wait for the gap to go. And if it doesn't quite come off, well, I get a little bit of theta, time decay on the options, I close a position, and it's a bit of a safer bet. Those are all types of strategies that you can start to use. Now, if it's your very first time trading, please don't try that at home. But of course, over time, the things that I've just said will make a little bit more sense, will become a lot easier for you to do. But for me, I will probably have a very good look at Disney, because it being up 9% seems like quite a big jump in the stock for a one-day move.
Well, they had positive earnings report, but long term, I'm not so sure. With the Disney parks are still closed in Florida, and the movie theaters are empty as we speak. I don't know, but they've done an incredible job, and also they got a lot of subscribers for their online movie services or so on. So they're okay. Coming back to Kasparov, just one observation. Number one, nobody ever saved the chess game by resigning. Okay?
Yep.
Before you say resign, look for opportunities. Maybe you'll find something. Now, in stocks, it works differently, because if you got position in stock and it went against you going down, if you're not going to pay attention to what's really happening and you will keep position, it will go even farther down. And there is no end how low it can go. So it can cost you a bit of money. So you always have to evaluate. I remember the old Investors Business Daily. Who was at the time editor? He wrote about 7% rule. He says, under no circumstances you should keep position in a stock longer than if you already lost 7% from the point when you acquired it. Sell. Doesn't matter what you think about the company, how great is the company and what they're going to do. Just sell it. Okay, once you sell it, then take a look. Maybe you buy it back, maybe at lower price. If you still believe that this is a good company, has great opportunities, but you have to rethink, because you thought about this company and great opportunity when you purchased the stock and it went down 7%. Something doesn't add up, or your observation is wrong, or the company is not that great, whatever. So just take your time, think about it, and think again. Okay?
Awesome.
Awesome, right? Yeah. Okay, guys, thank you so much for a great show today. I'd like to see you next Wednesday, and we'll discuss what's happened in the market and how your positions are doing and what's happened with the economy. Thank you so much again. Goodbye, and see you, everybody, next Wednesday. Bye-bye.